Hello and welcome back to episode 4 of Service to Savings. Today we're going to be talking about everything life insurance. Specifically, do you need it and when should you be getting it? So, I've always heard these sobering military scenarios, Craig, where you're deployed overseas or you just PCS to a new base. Life starts throwing you curveballs, right? You have that mortgage, the kids' tuition, spouse career takes a gap in it. And then the real question is, what happens to your family if something happens to you? And there's been, cases where I've heard of service members dying unexpectedly. And, the answer is life insurance is something that should be part of your toolkit. And, you need to add it. The question is how much and what's the right coverage? Do you need something beyond SGLI? We'll give you some rules of thumb and we'll hopefully help you set yourself up for success. One thing I know, Greg, is what's the thing that almost never fits in someone's.
Products that you don't need that are sold for the wrong reason. And because we're talking about life insurance today, we're going to talk about different types of permanent insurance. And I am biased because there's probably a place for almost every tool, but there's so many shortcomings and so many predatory practices that we could protect our community a little bit by talking a little bit about whole life insurance and universal indexed universal life insurance, or IULs, because I'm not going to say those three words every single time. Those can be very powerful tools for the right reason. However, they are patently overdiagnosed. It's like Ritalin everybody had ADHD in the 90s, right?
Right.
Um,
And I don't know about you, but I always thought of insurance in general as a transfer of risk, right? And
I mean, that's the way it's supposed to be. That's the thinking.
And when you add in that whole life insurance or that IUL, you start to conflate multiple tools. And right, I don't know about you, but if I ever went down, I was a deck watch officer, so I hardly ever went down to the engine room. But if I went down there and tried to pull out my Leatherman or a crescent wrench, I would get beat over the head, right?
Oh
Because
yeah,
it's
I'm confident that if a mechanic didn't jump you, then an electrician would, because you can't trust electricians.
right. And so that's the way I kind of think of those two tools is whole life insurance and IULs is they're kind of your Leatherman. They're, yeah, like, I mean, okay, but not the right tool to really do any of those jobs. Right.
Yeah. So when I left the Navy, I cut my teeth at a big Midwestern mutual company, household name, and I actually did an episode with Daniel Kopp in the transition to from military to financial planner episode, where I rambled for the entire time of our conversation. But I cut my teeth selling a lot of these products. And I don't regret it because, like, one, learning sales is important. Two, learning these products inside and out is actually really important. It makes me a better financial planner. And there is a place for them. So first, before I beat up a lot of these products, there is a place for them. Oftentimes it's in business planning or very much more complex estate planning, or even some of the behavioral side of why I might need life insurance let's insert the it depends, could be a good reason to have a permanent life insurance product. Oftentimes it's the wrong product because you have a temporary need, a fixed budget or a finite amount of resources, and they're often more expensive. Or again, you're conflating ideas, you're conflating purposes unnecessarily, and they get to pick and choose the data. Even though they have brilliant actuaries on their payroll, they're still cherry picking. All right. So we could certainly get into that. Tools are tools. Just not everything is a nail just because you have a hammer. It's that simple.
And so the way I like to think about this is life insurance serves a couple of different purposes. The first, but all of it comes down to transferring risk. The first is your spouse is probably going to be devastated, hopefully is going to be devastated, right? If something was to happen to you. And you need to be able to give them the financial security to have the time to mourn and recover and not put their financial life in jeopardy. And that could even come down to, as basic as how are they going to pay the mortgage next month, right? And so we have that initial need, that initial 6 months of how are we going to pay the bills. Then we also have how are we going to provide over the long term for our family if something happens to us. Because, the reality is your spouse is counting on your income, or even if you're not actively working, they're probably counting on your support in the household over that time, right? Whether it's taking care of small children or simply maintaining the household. There's a lot of work that a spouse that isn't working does. And so we need to be able to provide for that. And then finally, those big expenses that are coming up, possibly paying off the house, paying for children's college, and that's where there's a rule of thumb that comes up often, which is like 10 to 12 times of your annual salary is about the amount of term life insurance you need.
Right. I mean, so the 10x rule or 12x rule is absolutely the most common. There's You said that the key thing, and I break it down into qualitative and quantitative. So both the numbers and the behaviors or the feelings. When I have this conversation with clients and the people that I serve, the numbers part, you could do a quick calculation, like just back of the napkin. I make X amount a year, multiply that by 10, and that's going to give you a good approximation while you're in that accumulation period, or more specifically, when you have people that depend on you. Like, so if I still have a mortgage and me having a house is really important for keeping my kids safe and secure, that Maslow's hierarchy of
Yep.
needs, then I should probably have that covered. There's more mathematical things that they teach us as CFP professionals where I think there's about like 5 different types of calculation methods ranging from simple income multiples to this capital needs analysis. And there's also like the income, not so much the income replacement, excuse me, but like I think they call it the DIME. I'm trying to remember the acronym. It's debt, income, mortgage,
Education.
education. So you're trying to make sure that you pay off all the debt. If I died yesterday, make sure that my income is replaced so that my wife doesn't have to, or, the person I leave behind doesn't have to figure out how they're going to keep our lifestyle with half the income, right? The mortgage, oftentimes the mortgage, the single bit is a little bit different than consumer debt. That's why it's separated out. It's going to be the single biggest liability that anybody has.
Yep.
Whereas maybe the income can support it, but oftentimes it's Halloween right around now as we're recording this. So I'm just going to say my soul would be unsatisfied or unfulfilled. I would have things left over and I would come back and haunt all sorts of people if I left the mortgage on my better half, even if her salary could continue to afford it. So I would feel at rest if that was just paid off. And last but not least, I have 2 beautiful daughters that I hope will have the opportunity to go to college someday. I want to make sure that I have some thought in place for their education. So that's a DIME method. The other common one I just want to share with everybody real quick is the human life value. So this was actually pioneered back in like 1924 or something like that. And I don't remember. I have like Dr. Solomon or something like that in my head, Joe, but probably completely wrong. Maybe that's their Solomon's Temple where they had all the gold. But the human life value is this present value of all the money I'm supposed to make over my working years, which
Yep.
is comical to me because that's how I always make recommendations for umbrella insurance to the people I serve too. Like, hey, when I'm cycling down 10 Rod Road and there's a cyclist in his spandex, I sneeze or I pick up my cell phone and play a video game while driving. I swerve, run over this young 20-something-year-old orthodontist that makes $200,000 a year
Yep.
for the next 20 plus years. My family's getting sued for a few $1,000,000, right? And so that calculation, that top of that estimate is his human life value of what is $200,000 for 20 years discounted to today. And when I say discounting without having a finance lecture, a dollar today is worth more than a dollar tomorrow. I could buy more groceries now with $100 than I'm going to be able a week from now because inflation's stupid. But that's how it
Right.
works. Tangent aside. So those are some of the things that we know about calculating, well, what's the right number? But it's not always math, right, Joe?
It isn't always math, and you really have to look at that. Some of it's security for your spouse, right, and how you want them to be able to go forward. I know if I was to die tomorrow, military family, so we moved all around. We live in an area where we don't really have any family permanently, and our youngest is currently a senior in high school, so graduating at the end of this year. I could not imagine my spouse staying here if I was to pass away and not moving back to be closer to family, right? Which would then mean she would effectively be giving up her job, right? As well as, having the expenses of moving and all the things that go along with that. And that's something that's that intangible feeling that, maybe she would stay here, but the fact that she knows she doesn't have to really accounts for something for her in a peace of mind and a security that, I think is to some extent priceless, right, in her going forward. as well as her being able to take a leave of absence from her work if she wanted to or needed to be able to deal with the loss. That there's something to be said for that too.
So I think I rattled off, and if everybody droned off as soon as I started rambling, and they just rewound back to your 10 to 12 times rule, we have a number of how much I might need during my working years. And that's my hint that the next thing that we should consider is like, well, how long do I need it? Right. So while I have kids, typically what we do as planners, we say you need it until your youngest is like a self-sustaining adult. And
Which
for some
does not
family,
correlate with college graduation, by the way.
you're exact. For some very fortunate families, that could be 16 or 18.
It could be.
For what I see in a typical world, that's anywhere from 22 to 26 years old, that you as a mom or dad want to be able to support somebody. And you know what's funny? It's actually not even just kids. Like if you have aging parents and siblings or no siblings, like why not consider them? Like if you disappeared, you still want to be able to care for these people. So that's one of the powers of life insurance. But what we're trying to do is say, I'm going to need to transfer risk to this company, the insurance company, for this period of time. And I might be able to self-insure it. So self-insure is where we've saved up the income, like we've created a nest egg of assets, or I have the actual cash flow naturally to absorb that risk, which for catastrophic losses, I guess there is a break even where that makes sense. But for most of us, it's so cheap for us to buy a term insurance product or a group term insurance product, term being for a term of time. It doesn't last into perpetuity or forever. It's so cheap for us to buy that it makes sense to cover that period of time doing that. And the SGLI, so for all of us service members, we have SGLI, which is a group term product. That's what is it, 25 or 26? It's like 35
$25 a month for $500,000 in coverage.
with no medical underwriting effectively.
And no exclusions either, right? If you die skydiving or diving, scuba diving, right, you're not excluded. And that's the thing with a lot of those other term policies is they have some fine print on them. And there's some things that if you do it, which in the military, a lot of us tend to do
We
a lot
check
of
all
those
the
things.
boxes for don't do this.
Yes.
Don't go into a war zone. Please
Right.
don't fly airplanes, jump out of airplanes, scuba dive. Don't do anything violent, like all of the things that we're likely to do in the course of
Yes.
work is an exclusion.
And so you need to be careful with what company you use to buy that term life insurance that they're not going to eliminate that. But I think one of the key things, Greg, is you don't need to get all of your life insurance. So if we're going to do just some easy math here, $100,000 a year, right? Times 10 years, $1 million in coverage. Okay. Well, SGLI is an easy half of that, 500,000. But that other 500,000, you might not need full for a 30-year term. Maybe you need 200,000 for a 30-year term, and another 100,000 for a 20-year term, and another 200,000 for a 10-year term. And you might base that based on a couple of different things. Like, do I have children graduating from college and becoming self-sustaining? Do I have a mortgage that's going to be paid off, and so I don't need to pay that off anymore with the insurance? Am I going to retire from the military, and so my spouse is going to have this SBP, and so maybe some of that can go away. Am I going to start claiming Social Security? When are they going to hit Social Security age? Because that might be another time when some of the coverage can go away. And so you start to build this kind of ladder, right? Or set of stairs. And you have, if you imagine, kind of at the top over here on the left, you have like something that falls off after 10 years for amount of coverage, something that falls off after 20, something that falls off after 30. And then hopefully by that point, you're self-insured, meaning you have enough in your retirement accounts that you don't need the insurance anymore. You can get a little bit more bang for your buck and save a little bit of money by doing that.
Yeah, I mean, absolutely. Timing that, well, it's not even arbitrage, not right the right word, but like matching that risk with when the money is due is part of how we're going to insure these risks, right? When my mortgage falls off, I don't need as much coverage. I have a new client that recently retired after a 30-year career, and his wife, now that they're not PCSing every 3 or 4 years, is gainfully employed as a GS11. And so she has the federal GLI, and his retirement income is still such a large portion of their household income that they're like, do we need this? And I'm like, it's dirt cheap and it actually will make things feel better mathematically. No, you don't need it. Why? So he had the SGLI while he was serving, but his kids are adults and he has the survivor benefit plan. So his pension income is protected in case he prematurely passes for his spouse. So you know what? His math, that instance between the debts that they still carried and what their real family risks are, I was completely comfortable saying, guess what? Now that you've retired and you have all these guaranteed streams of income with all these beneficiary arrangements, we're good. You actually don't need to buy life insurance. Really, Joe, one thing that I do see is that even when there's a mathematical zero, like, hey, you actually don't need any insurance, find behaviorally, oftentimes people like to have a little something,
Right.
whether it's just a final expense piece, like I have like 15,000 or whatever, assuming that the VA isn't going to step in and pay for it all, or hey, I'd like to leave them with this chunk, either for a legacy or for this philanthropic need, or I would just feel good if I left something to these people that mean everything to me. That is a great reason to still keep insurance. And honestly, that is a segue where maybe the timing of that payout, you might consider a permanent policy. But in the term space, that's one of those times where mathematically it just feels better. Like it just makes things easier. And honestly, collecting the death benefit from a life insurance policy is I don't have the data in front of me to back this up, but I'm willing to guess 9 out of 10 times it's easier than closing on bank accounts and anything else that is in the estate of or trusts or anything that's passed. Like it's still more boxes to check for continuity than this is the death certificate. Please give us our death proceeds.
And I especially like that when the spouse is still working, just because it is super hard to predict how your spouse is going to react to you passing. And so, uh, if something was to happen, you don't know if they're going to be able to continue working or if they're going to need to take a year or two off. And if you can provide them that kind of flexibility, I think the cost is so low often for that kind of flexibility that it just makes sense to do it. You're talking, $20, $25 a month, so less than a dinner out, for $100,000 in coverage probably gets your spouse, the better part of a year of not having to worry about whether they're currently working or not.
Yeah. Just because we brought it up at the very beginning, because the military community is so often victims or victimized by this predatory practice of permanent insurance, I want to spend some time talking about that. So,
Okay.
the difference between whole life and term insurance is that whole life, and I'm using that just as the proxy for all permanent insurance products, not just whole life, because whole life is different from variable life, which is different than indexed universal life, which there's several flavors of that as well. The idea here is instead of only lasting for a term of time, it lasts your whole life. So when you check out, that's when they will cut a check, so long as you continued paying premiums and you didn't lapse the policy. Now, the reason that a lot of these products are sold is because they have this internal function called cash value. Now, that's not just return of dividends and all that stuff. There's more nuance to it. So just to keep it simple, it creates a value in addition to the death benefit by paying these premiums. Now, the premiums are often significantly more than the term component. So like if I bought $100,000 or a $500,000 term policy for 25 to $50, I'm probably spending $300 to $500 for the exact same death benefit of a permanent policy. Now, sure, that covers some of the mortality and expenses underneath the hood, and it lasts for forever. So they're taking into account some actuarial future risk. There is a much higher annual cost for these policies. Now, like I said, there's a lot of uses for them, but I'm going to get back into why they're sold. So the benefits of these products, before I get into why it's not a good fit for most of us, is the death benefit oftentimes will actually increase. Like that's one of the riders or one of the features that they can do is say, hey, you're going to pay this much and your death benefit's going to go up over time because the cash value goes up. Or you can do what's called this power of 0% or be your infinite bank or self-banking. I'm doing a lot of quotes here because there's 1,000 different names for this thing. And I've seen it work twice in reality.
Doesn't it seem like, at least to me, Greg, every time someone goes in and definitively debunks or the government gets in the process of going, like, you guys are being dishonest with your advertising, they create a new name for it,
Oh,
right?
yeah. And listen, I read a book on the subject on this self-banking and this infinite banking, and it was very compelling. And some of the math is great, right? And so let me explain how it works. So you have this permanent insurance policy that has cash value. And the idea is if you take a loan from a life insurance policy, loans of all types. Well, all right, so not all types. So I'm not going to blanket statement that, but almost all loans under the Internal Revenue Code is not income or taxable income. So if I loan myself money from this policy, I can effectively use my policy's growing cash value that's usually invested in some really robust portfolio that the insurance company has done. Like the big Midwestern that I work for, they own properties all over. Their real estate portfolio allows them to do absolutely insane things that just earn so much. They own Tyson's Corner shopping mall down in Virginia, by the way, or did. And I think one of the like something in the Seattle Needle, but I can create income from that. I can borrow against that thing. So you're taking income from this and paying no tax. Now, you could also take distributions, in which case all the agents would be like, don't take distributions. That's the wrong way to do it, because then you could get taxed. You could get a 1099, or you could mech your insurance product and ruin it. And that would be tax advantage. They say, what bank is going to loan you your own money and pay 0% on it because it's like you're getting dividends on top of the money that you borrowed, and you would pay yourself back, or you never pay yourself back and it just gets subtracted from the death benefit when you die. Right. So there are these cool ways, and I have seen it work. And I've actually seen people put the money back, which is the right way to do it. But the most people don't do that. They just keep paying premiums and premiums, and it doesn't actually serve the way that they want it to. And one of the ways is, this is the rich man's IRA or Roth IRA, because you make too much money, you don't qualify for a Roth. Well, with backdoor strategies, that's a stupid argument. But it's not a rich man's IRA. It's a corporate and banking product. And even then, it's not as big of a percentage of their portfolios as salesmen make it believe. So they're coming out and selling the military these overpriced products that do have some really incredible features, but we don't need it. There's an easier way to do it. I don't need a different tool to fund my kid's education, right? So one thing that we'll sell was like, oh yeah, buy a life insurance policy on your kid. Not because you think they're going to die, but because that cash value is going to grow and you can use it for college. Well, you know what? I get a state tax deduction by participating in the 529. So I get a little bit discount on the way in. It's going to grow tax free, and it's going to grow tax free and come out tax free as long as these are qualified education expenses. They would say, well, the market could go down and it can't go down in your policy. No, but your sales, in-force illustrations and everything like that aren't going to be completely devoid of market risk either. And that's not what this policy is for. It's an insurance product. It's for death. There's a lot of great people that will beat it up actuarially, and I don't have enough time to beat it up in a podcast, but I can go on for days with the actual numbers. So we're just sold the wrong thing when there's other better tools.
And I think that's the thing is, right, we're trying to mix multiple things. We're trying to mix an investment with a banking, with a insurance, and we end up with this, Swiss Army knife that kind of like, okay, in a pinch, yeah, but there's better tools that you could use to do the individual jobs. And since we have the availability of those tools, we should be looking at those. And quite frankly, those other tools are often cheaper in the long run than using the Swiss Army knife for everything.
Right.
With that in mind, there's one other thing that I think we need to address about insurance, and that is when you go to transition out and when you should start pursuing insurance then. I know I have some definitive thoughts on it, Greg, but I'll toss it to you first and let you talk about that.
So I do too. And I mean, really for me, when we're transitioning out, part of the conversation is, do we convert from SGLI to VGLI? The other part of the conversation is, again, what do your retirement benefits look like? VA disability? Do you have any pension? What are the benefits at your new job, right? Because if you have a robust group policy at your new job, let's go back to the math and your feelings. How much do you need to make up? That's the main thing. And then comparing private insurance to the VGLI in terms of a cost and claims paying ability. What about you?
And so I like to think of it in a couple different ways. Is ideally about a year before you get out, right before you start going to all those medical appointments for all the problems that you've had the entire time you were in but never got seen for, which most of us do. You want to get that insurance in place before you start getting diagnosed with things. So, especially so I retired after 25 years of service. Ideally, like my life insurance was in place before I started going to those medical appointments that last year to get everything on the books for, the VA, and to make sure that, I was taken care of and everything was documented that the military broke on me, while I was in the service. So you want to do it then because it's going to be cheaper, quite frankly, right? You don't have the medical diagnoses, you don't have the issues on paper. And so at that point, You can answer the questionnaires honestly and go through the process and get your underwriting better and end up getting a cheaper term life insurance policy. Then beyond that, the big thing that you want to look at, especially if you're retiring from the service, is there's often a gap between when you retire and when you start claiming Social Security that your insurance need actually goes up quite a bit from when you were on active duty. And this is because once you hit that window, your spouse is going to need a little bit of extra income to help supplement if it was to go down to the survivor benefit plan or that 55% of your pension. And so if you want to maintain that lifestyle, life insurance to cover that gap is quite important. And then you can start to let it fall off as you get further towards, okay, I'm at 70 years old. I'm claiming Social Security. That, you can start to have that fall off at that point and be fine. And then finally, think about that ladder and what life events are coming up or hopefully coming up and, what events you'll need and, start looking at that. There's a couple of military friendly organizations out there that I personally like to use. USAA, believe it or not, I've had pretty good luck with their life insurance and using it with people.
Navy
They,
Mutual.
they tend not to upsell you too much on it, which is nice because they're living off commissions, right, for most of the insurance salesmen. So you don't want someone that's going to upsell you greatly. The other one that I found, and I don't know if you've ever used them, Greg, is Navy Mutual Assistance. Have been a great organization over time that I found that a lot of people have great success with.
Not to be confused with Navy Federal. While it's a great credit union, I don't like to get my insurance through them. But Navy Mutual is reputable. And then Armed Forces Mutual is
Okay.
a similar one that's really good. Not that we're trying to like call good like companies that we prefer, because I don't necessarily have a preference. These are important because they actually have military specific support features, right? So we already mentioned that like if you go with a big player in the private insurance space, they have exclusions for your military and prior military stuff. And God forbid you get like a PTSD or so my Navy career ended prematurely because I was medically retired for 2 diagnoses of cancer at 27 years old. Like you're not going to predict that. I was peak health, thought I was Superman. It would never happen to me. And now I'm retired. Luckily, I have a VA disability, which has its own life insurance-esque type
Yep.
benefit, but it's not life insurance, sort of like a death gratuity type thing to cover if I die from my ailments. But I could easily like those history that I'm going to take with me from the Navy are going to preclude me from getting protection outside. So what Joe was talking about earlier is getting this done before you're going through med board at the end, or when the needs arise, you can be conservative. You can get like a buffer above and beyond, knowing that life has a growth pattern. And the best time to plant a tree was yesterday. The second best time is today. So like if you know like, hey, we're talking about having kids, then maybe we should be looking at life insurance or getting this preemptively is smart. If you know you're going to get out, let's go ahead and cover everything, because if you don't try and claim every single thing that's wrong with you or ever been wrong with you or thought about being wrong with you before you get out, you should be claiming every single paper cut. Unfortunately, they're getting rid of tinnitus if they haven't already. So sorry, we're all stuck with the ringing in our ear. The VA is sick of hearing it. Get it? Hearing it.
That was a great pod.
But yeah, like there are good companies that will take care and are designed to work with us.
And that's why I like those particular companies is because, during that overlap time of you have the policy in place, but you're still on active duty, they don't have the exclusions that the other big companies are going to have that could preclude your family from getting the payout when it's time.
Yeah, and I mean, VGLI is super easy. It's ridiculous. So Veterans Group Life Insurance is super easy to convert your SGLI into VGLI, especially if you're younger and you have kids and stuff like that. It is pricier, substantially pricier than your SGLI. And the other thing, that caveat that I want to warn you all about, which I feel like should be common knowledge, but it could also just be common knowledge because I talk about it all the time, is that insurance, especially life insurance, gets more expensive as you get older because the likelihood of you dying increases. That
Yes.
risk becomes a known quantity real fast. So you might want a policy that lasts your whole life, but you really probably only need it for the certain tranche that probably falls off right before the normal retirement age.
Right. 100% VGLI gets much more expensive as you go up in age. Every 0 or 5 birthday, so the year you turn 50, the year you turn 55, the price goes up. And just to give everyone a price point, if you remember, we said it was $25 while you're on active duty for $500,000 in coverage. At the age of 65, for that same $500 in coverage, it's going to be $735 a month. So $710 more than when you are on active duty per month, not per year, per month. So usually for me, if I'm using VGLI with a client to kind of fill some of that gap, it's usually till age 49 is the last year, because that's the year to me when like the cost starts to ramp up too much in my mind, and commercial products start to be a better option. So that's kind of how normally I break it down. Now, always it depends, right? Depending on your medical conditions, some other things, VGLI may still be the better option.
I mean, it might be your only option, which is why I always evaluate it. If you have a clean bill of health or the bumps and bruises aren't going to preclude you from other options, private insurance is always a good thing to evaluate as well.
Yep. Well, I think we went on about life insurance. Sum
It's
up,
riveting stuff. I don't understand why people want to listen to it.
it's what everyone loves to think about. To sum up,
Dying.
right? Some life insurance is probably in order for you until you hit that age of, right around normal retirement. Every situation is slightly different. You should definitely consider commercial products when you go to get out of the service, ideally that year before you go to transition out, before you start the medical process. You also, SGLI is an excellent, very cheap option. VGLI can be a good option. The best part about it is you are 100% qualified for it when you get out of the service, no matter what medical conditions you get out with. So starting out with that as an option is also a good idea. As always, right? You can grow your finances confidently with guidance from the Military Financial Advisors Association. Visit militaryfinancialadvisors.org for free resources to help military families and veterans build wealth. Please subscribe to our podcast for exclusive financial tips and updated tailored to military members, military spouses, and veterans. With these strategies designed for service members, you can achieve financial success. And when that success brings complexity, keep MFAA, the Military Financial Advisors, in mind and go to militaryfinancialadvisors.org to begin working with a fee only financial advisor. They will help you navigate that complexity and help you achieve success and live out your best life. Thanks for joining us. And until next episode, I'm Joe.
And I'm Greg. It was great talking with you guys.
See you next time.
The information provided on Service to Savings, the Military Financial Advisors Association's podcast, is for general, informational, and educational purposes only. Nothing contained in this podcast should be construed as financial, investment, legal, or tax advice, nor is it intended to be an endorsement or recommendation of any specific product, service, or investment strategy. Always consult with a certified financial planning professional, preferably an MFAA member, before making any financial decisions, as your personal circumstances, including military benefits, TSP contributions, deployment-related finances, or retirement planning may require tailored advice.